Hey options auto traders, welcome to the first lesson in this masterclass where we're going to be discussing selling puts. Why? Because selling puts is the basis for almost every single option strategy. If you understand what puts are, selling puts, and all that, then you'll be able to understand the rest of the strategies. Also, selling puts in and of itself is one of the most simple income strategies, which means that if you do this, you'll be able to make consistent income every single month just by doing one or selling one simple option. So let's dive in and first discuss some very important things that most people don't discuss, like what market does selling puts work best in? And so it works best in bull markets when markets are going up, and it works best in sideways markets when the market is very range bound. That's where selling puts thrives. If the market starts to drop, you're going to lose a lot of money. Next, who this strategy works best for. It works best for someone who wants slow, consistent profits. Guys, when you're selling options, you become the casino, you become the house, which means that you don't have any huge winners. You just have a lot of small, consistent wins, and over time, you're playing the numbers out, and they work in your favor. You're doing the same thing when you're selling options. You're the insurance company. You're collecting these small premiums, and you almost never have to pay out. And when you do, I can actually show you how to mitigate those losses in a bit. Next, it's for someone who wants passive income. If you're someone who's like, I just want a simple strategy to make some good money every single month, and I just want something that's simple, this is for you. Next, what are the cons of this strategy? The strategy will lose thousands during a pullback or a market crash. So if the market is pulling back or crashing, you got the potential of losing thousands of dollars. But if you stay tuned on this trading, I'm actually going to show you how to mitigate that so that you don't actually have that risk. And the last con is that it's slower than you think. So guys, typically when you're selling options, it's the slower game. So you will take about 2 weeks to start seeing profit and closing out a trade compared to like your quick trades where you're in and out in a day or two. Next, what are some of the account sizes and limits that we need? Well, first and foremost, you need full margin approval on your broker account. So if you're trading with Tasty Trade, that means you want to use the Works account, which will give you full margin approval, and you'll be able to do this. If you want to trade things like futures, you'll need $10,000 in buying power. If you want to trade things like ETFs, you'll be able to do it with about $20,000 in buying power. There's other strategies that replicate this approach, like credit spreads that require less buying power, but we'll be getting into that further in this lesson or further in this course, but we just need to set the frameworks with selling puts first. So how is the selling put strategy constructed? What does it look like? Well, we're just going to take a put and we're going to sell it. If you don't know what a put is, a put increases in value, goes up in value as the market drops. So you can think of puts as shorting. When the market drops, puts go up. So if you want the market to drop, that's how puts make money. But when we're selling it, we're doing the opposite. So that means that we want the market to go up so that the put's value drops. When the put value drops, we make money. So I think I got a bit too complicated there, but don't worry, I'll simplify it here. The puts are entered far out of the money. So if we look at here, here's where the stock is currently trading. So the stock is trading here. When we sell puts, we're betting or hoping that a stock stays above a certain level. So we're going far away. We're going like this far below the stock. So I'm giving the stock this much room to move. As long as it stays above this level or can even drop this much or something like this, this is where the stock's moving, things like this, then I will make money. I make money as long as the stock stays above the level I pick. So what we do when we sell puts is we pick a or a level that's far away from the current stock price. The further away we go, the higher our win rate. So that's what we're looking at. We go far out of the money, which means far away from where the stock is. These puts are used as the base of basically every strategy. So if you sell puts, that's where your income comes from. So you're selling this down here, and in order to do it, you are getting paid money to do it, okay? The further away from the stock you go, the less money you get paid because the less likelihood of the stock reaching that point. But still, you get paid money by selling this put. So that's the base of the strategy. So moving the puts closer to the money or closer to the stock price will increase your income because you'll make more, but it'll decrease your win rate because it's more likely that the stock will drop and hit that level. Now, when we're selling options or doing options, there are some very important components like days until expiration. So delta tells us how far away from the stock we're going, and days until expiration tells us how far in the future we're going. So we tend to go for 45 to 120 days when we're selling options. So that's typically what we look at. Now here is the profit graph of selling a put. What we do here is we sell a put, so we collect a defined income amount. You can see here this green, it kind of tops out because the money that we received when we sold the put, or the premium, or the income, or the insurance money that we received when we sold this put, is the money that we get to keep. If it breaks our level, right, this level that I'm discussing where we want the stock to stay above a certain level, then we start losing. So you see here when it breaks that level, then we start losing. First, it eats into the profits we made, and then it starts going negative. So that's something you have to be aware of. Next, how do we manage this trade? So we put on this trade by going away from the stock price about 45 to 120 days out into the future, and then we sell a put. Now, how do we manage this trade? What do we do for stop loss, for take profit, and all that stuff? Well, we're going to follow Tasty Trade Mechanics. If you've never heard of Tasty Trade, they're a great platform that does a lot of research around this, and this is what they found works best, so that you can have an 80 to 90% win rate and still make good money. So, stop loss, again, they don't like to do a stop loss, but I like stop losses. Their research has shown that a 300 to 400% stop loss is the best stop loss when you're selling options. So again, this is going to be based on the initial credit received. So once you've entered the trade, you want to close out that trade for a loss if it gets to roughly a 300% loss. That means that if you received $100 to put on this trade, then once it gets to $400, which meaning that the net difference between them, 400 to 100, is a $300 difference. That's a 300% difference, and that's when you've hit your max loss and you want to close out the trade. Next, early management. Tasty Life Research recommends to manage short options like puts at 21 days, meaning that you're going to exit the trade when there's 21 days or left in the trade. So let's say we entered the trade with 45 days to go. Once 24 days have passed and we get to 21 days left in the trade, then we close that trade. It helps reduce a lot of gamma risk and vega risk and things that like that. So just by closing the trade early, we end up just collecting a profit faster and avoid some risk with that. Next is take profit. You typically manage your profits between 10 to 50%. Again, 30% is great, 10% is great, 50% is great. If you follow the Tasty Life Mechanics, their way to manage a selling put is to do a 50% take profit with a 21 days early management. So, next, what are the best practices for the strategy? Well, like discussed, you're going to sell puts at the 10 delta level, which is going to get you very, very far away from where the stock is currently trading. You're going to go 45 days out. You're going to manage the trade by having 21 days until expiration, and a take profit of 30% based on the initial credit received. 30% is what I found via back testing and personal experience to be a wonderful performance because, again, I get out of trades in about a week or two, so I'm able to collect profit faster, which is going to help me increase my win rate. Next, how do I automate these best practices into the options auto trader? Well, if you're just looking through this document, you can do this here, but again, I'll just walk you through the process. So what we do is we're going to go into create an auto trader. We're going to connect our Tasty Trade account. We're going to create an auto trader, and I'll show you how to set this up from scratch. So we're going to sell puts. That's the strategy we're doing. We get to pick the asset we want to do it on. So we have a larger account. We can do it on SPY or SPX or a futures. If we have a smaller account, then again we'll probably want to do a different different strategy because this takes a lot of buying power. But let's say I just want to do it on SPY. 45 days out, 10 delta. Again, this is preloaded with the best practices. You can see here the best practices of this already built in. So just like that, the 10 delta for my strike selection. Next, how many times do I want to enter? Do I want to enter once a week, 3 times a week, every day? Again, when you're selling puts, if you have the money more active, the better. You want to do small trades. You want to trade small, trade often. That's the Tasty Life type of mantra. And just like that, we can set that up. So this is once a week on Wednesday. Next, what I say is that about 30% take profit and early management of 21 days. So we're going to close the trade when there's 21 days left in the trade. I don't have a stop loss. It's just giving me a warning. I understand that. Next, buying power allocation. How much money do I want this auto trader to trade with? Well, again, for selling puts, we're going to need some decent money. So let's say $20,000 would be good to go with. Again, once we get to the next page, it'll show us how much money we'll actually be using. Now, if you want to maintain full control of your account, you can require email trade approval. Again, by default, it's disabled, so just to let the automations work. But if you want to approve a trade before it goes live, you can enable this, and we'll send you an email approval being like, hey, all the rules have been met. Do you approve this trade? Yes or no? Now, remember how I said one of the biggest issues with selling puts is that if the market pulls back or crashes hard, that you could lose thousands of dollars? Well, I built a simple mathematical prediction that shows when the market is likely to pull back or crash. And so again, it's kept me out of some amazing pullbacks and crashes like COVID, like the ones recently this year in 2024. And so it's awesome. And so if you enable this, it will close out your positions before the crash starts happening. Again, it won't get you out of all crashes, but it will get you out of most crashes. Next, just like this, you can see here for SPY, it takes about $6,500 of buying power to sell one put. So again, you can see here I'll make about $300 per trade based on my profit potential, and I'll be risking about $10,000 per trade based on the stop loss I have, which is in existence. So about the average of 21 days. So if you want to fully understand what it's doing, you can read the summary here. If not, you can authorize and save the auto trader, and you're done. All right, guys, that is how to set up a selling puts strategy, what it is, how to trade it, why it works. Again, you can get this document linked down below if you need it. But anyways, I'm Austin. I will see you in the next lesson.